Welcome to week 8 of Business Economics. The purpose of this unit is to provide a general introduction to the aggregate demand and supply model. Aggregate demand is a schedule that shows the various amounts of real domestic output that domestic and foreign buyers will desire to purchase at each possible price level. The aggregate demand curve shows an inverse relationship between the price level and domestic output. The determinants of aggregate demand are the other things besides the price level that can cause a shift or change in demand. Effects of the following determinants are discussed in more detail in the text. We have changes in consumer spending, which can also be caused by changes in several factors such as consumer wealth, consumer expectations, consumer debt levels, taxes. Changes in investment spending, which can be caused by changes in several factors such as interest rates, profit expectations, business taxes, technology, and the amount of excess capacity. Aggregate supply is a schedule showing the level of real domestic output available at each possible price level. Aggregate supply curve may be viewed as having three distinct segments: the horizontal range, where the price level remains constant with substantial output variation; the intermediate or upsloping range, where the expansion of real output is accompanied by the rising price level near to where the full employment level of output exists; and the vertical range, where absolute full capacity is assumed and any attempt to increase output will bid up resource and product prices. We assume full employment occurs at the natural rate of unemployment. The determinants of aggregate supply are the other things besides the price level that cause changes or shifts in the aggregate supply curve. In the last part of this unit, we introduced the concept of the Phillips curve. Real GDP and unemployment are inversely related, so the opportunity cost of reducing unemployment is higher inflation, and the opportunity cost of reducing inflation is higher unemployment. In the short run, changes in aggregate demand are movements along the short-run aggregate supply curve. If aggregate demand moves upward, price level rises and real GDP rises. This results in higher inflation and lower unemployment. If aggregate demand moves down, the price level falls and real GDP falls. This results in lower inflation but higher unemployment. Under normal conditions, there is a short-run trade-off between unemployment and inflation. But the economic theory stipulates there is no significant trade-off between unemployment and inflation in the long run.